Good afternoon, Dan. Thank you for joining us. We're very excited to have you deliver a keynote talk at the upcoming Inside ETFs Europe's conference here in London. We're certainly seeing a lot of headlines and a lot of news around ESG and sustainable investing, but many people really aren't quite sure what that is. Could you kind of give us a quick definition of what sustainable investing is?
Yeah, it's a good question. There's a lot of terminology. We used to hear about ethical funds and socially responsible. There's really kind of a growing consensus around this sustainability terminology. We at Morningstar define sustainability as a long-term investing approach that incorporates environmental, social, and governance criteria into investing. And we're really seeing it being adopted across the board, including by sort of mainstream asset managers.
So when we start to look at the adoption of it, there's obviously the talk that anything that's new can be just a fad, but are there really kind of long-term indicator drivers that show that sustainable investing might be an actual long-term solution for investors?
Yeah, this has long been an approach that's popular with institutional investors. So, the likes of the Norwegian Sovereign Wealth Fund or the Swedish Church of England, big pension plans in the U.S. like CalPERS have long paid attention to sustainability criteria. But we're seeing a lot more adoption now at the retail level. And if you look at assets, there are over 22 trillion are invested sustainably globally, and that's up like 6x over the past 10 years. In terms of long-term drivers, demographic shifts are definitely at play. So all the studies show that millennial investors, folks in their 20s and 30s, care a lot more about sustainability than baby boomers or the generation before them. Women investors as well. And as assets are transferred to those two constituencies, it's very likely that a lot more money is going to be put to work in sustainability. And then on the other end, there's a growing recognition that this isn't just about values. It's also about financials. And companies that pay attention to their risks on the E, S, and G pillars are just being sensible and can have actually a positive impact on performance over the long run. I think it's about both values as well as risk mitigation.
Speaking of risk, there's certainly, some might say, a big risk sitting in the White House there over in the U.S. Could government policies kind of derail what we see kind of taking place within sustainability?
It's interesting. So at the same time that, the political dynamics are at work, we've seen big index providers, the likes of Vanguard, State Street, BlackRock, increasingly paying attention to ESG factors with the companies that they own for the long term. They're replicating indexes, and so they're stuck with their holdings. And we've seen them get a lot more active shareholder resolutions. There was a big, on the same day actually that the U.S. withdrew from the Paris Climate Change Accord, there was a big Exxon Mobil shareholder resolution that passed with the support of those index passive managers that I just mentioned, calling for climate-related disclosure. So there's a lot happening at the bottom up, at the grassroots level, to push for more disclosure and more attention to risk at the ES&G levels.
But with all of that said and all of the great kind of momentum and trends that you have kind of pushing sustainable investing forward, investors are always going to look to performance. Are these funds able to deliver the performance investors need to meet their end financial goals?
Morningstar, we've introduced a sustainability rating for funds, and it has a limited history, but we're able to look at the performance of the funds that get the 5 Globe rating, the 4 Globe rating, which are our highest sustainability ratings. They perform pretty well. In aggregate, they perform a little bit better than the average fund. Now, on the indexes side at Morningstar, we have a sustainability index family, and we've seen the performance, the risk-return profile track pretty closely to the broad market. If you look at the academic literature, it seems that there's a growing consensus that there's really not a performance penalty associated with paying attention to ES&G. So you don't necessarily have to sacrifice returns. Now that said, you are going to end up with portfolios that look different than the overall market, and depending on market conditions, if there's a huge rally in coal or tobacco or an industry that might be a little bit less favored through an ESG strategy, you might see those lag. So, over the long term, though, we think that you shouldn't have to pay a performance penalty for paying attention to ESG.
Well, Dan, we are just out of time here. I appreciate you sitting down with us and look forward to seeing you in London.